Good morning. Welcome to the Antipodes Global Investment Company Quarterly Portfolio Update. Your hosts today are Jacob Mitchell, Chief Investment Officer of Antipodes Partners, and Andrew Findlay, Director of Company and Managing Director of Antipodes Partners. Go ahead, thank you.
Thanks very much, and good morning, everybody. Thanks for joining us for this quarterly shareholder update for the Antipodes Global Investment Company. We'll be talking to a presentation today that is available on our website, antipodespartners.com. It was also distributed to those who registered for the call via email, and you can also find it on the ASX feed under the ticker APL. We're planning to take around 30 minutes, including questions, so let's get straight into it. In terms of the agenda for today, we'll start by talking about performance, particularly portfolio attribution over the most recent quarter. It has been a tough quarter for us on the portfolio side, and the positioning and outlook from this point. And then we'll also talk about the share price and the discount to NTA and how the company is intending to address this. Just to frame the discussion around performance, firstly, let's have a look at slide 3, which is titled Understanding LIC Returns. Now, importantly, the foundation for all LIC returns is the performance of the underlying investment portfolio, and that's managed, as you know, by Antipodes Partners, the Sydney-based manager, and Jacob will be talking to the portfolio performance specifically in a moment. In addition to that, there are company-level capital management decisions, some company-level costs, and tax paid at the company level that gives rise to the company NTA performance through time. There's an important distinction there, as we'll get to in a moment. And then finally, the share price performance, so how the share price trades relative to that NTA over time. And we'll be addressing, as I said before, the discount to NTA later on in the presentation. Slide 4 looks more specifically at performance across some of those different measures. There are 4 columns of numbers there, starting from the left, global long short. Now, this is the equivalent managed funds to the portfolio that is in the company. The company's portfolio is represented there in the second column by APL portfolio. As you can see, over all time periods, bar inception, the returns are roughly similar. It is managed in a very similar way to the equivalent unlisted managed fund. The difference in this inception number really just relates to the inception date. In the case of our longest track record, being the unlisted fund, that was July 15, in relation to APL's portfolio, that was October 16. So roughly 2.5 years since inception of APL. If we move further right, you can see the company column there, and the primary distinction between company level performance and portfolio performance has really been the impact of options dilution. Those shareholders who invested at IPO received an option for every share they acquired at IPO. The expiry date for those options was October 2018, and around 93% and a bit of those options were exercised, leading to a material dilution in the NTA. Of course, shareholders who've invested with us since inception should add the value of the shares that they acquired through options exercise on top of their original shares to get their individual performance. One final point on this slide, I'll just point out the upmarket, downmarket capture statistics, or capture ratios, we call them. This is, of course, a long-short portfolio, so for roughly every $100 invested, $90 goes into long positions, roughly $30 into short positions, giving a net equity exposure of 60% or so. You can see there since inception. Now, that provides protection over the cycle in times of difficult markets, when markets experiencing downdrafts. It also acts as a headwind, having that lower net invested position and the shorts on in sharply rising markets, as we've seen more recently. So with that, I'll pass on to Jacob, who will just talk through the attribution in a bit more detail and the positioning of the portfolio going forward.
Thanks, Andrew. And just turning to slide 5. First of all, I'd just like to cap off on calendar year 2018, where by the end of the year we had sort of achieved some positive alpha ahead of the benchmark, primarily driven by contribution from the short book. Our long positions did lag the market, and that was really a consequence of potentially being a little pro-cyclical too early relative to the slowdown in the global economic cycle, and also just the contribution from some of our, in a very growthy market, our exposure to the Chinese internet growth stocks didn't contribute the alpha we expected for stock-specific reasons. And our reassessment around those has really led us to reduce our holding in our core holding there and reduce the size of our exposure to Baidu. But we've certainly taken that experience and the lessons we've learnt there to leverage more broadly across the portfolio. But the key issue has just been a far more competitive environment in Chinese internet than we expected. On the short book, what worked ultimately was in the final quarter, we did get paid on some of our, let's call it, lower quality growth shorts, let's call it irrational sort of growth cluster, and also some of the credit sensitive shorts also kicked in. Now, looking at the last quarter, it's been a tough quarter. A lot of the hard work of last year has been undone in a relatively brief period of time. Key issue for us has been just there's such a strong rebound following the Fed sort of pause in response to weakening data in the US. That has been expressed, and the flattening of the yield curve has really led to this violent re-rating of any type of growth. And the nearer term and the higher growth, irregardless of the quality of the underlying business, the harder the bounce. And there's also been a fairly violent bounce in anything that was highly leveraged. So 2 of our short clusters have really performed quite poorly in that period. Now, we ultimately build the portfolio based on the opportunity that we see at a given point in time. Arguably, even though that is the underlying premise, we should also be, we need to learn to be a bit more tactical, and that's, we have the resources, I think, in the team now to be a little bit more tactical, and hopefully that is a lesson learnt. So turning to slide 6, what do we see in terms of the outlook? Where are we focused? We still see some underlying tail risks apparent in markets. The Fed pause simply highlights, I think, how sensitive the economy is to monetary policy, and I'm not sure if that's necessarily a healthy thing. And the build up in, if you look at the dynamic that we've experienced since the global financial crisis, it really has been, an asset-led recovery. If you look at some of the key activity indicators, it's really questionable whether QE is actually working. Take, for instance, the US housing market. More than 10 years on from the crisis, we have housing starts that are 20% below their very long-term trend. So affordability, in many ways, the Fed has inflated asset prices, including housing prices, which is creating affordability issues, which is feeding back into lower suboptimal activity, and also you could argue social instability, and we can see that across the world, polarization at a political level, and a lack of consensus on what policy should be. So governments are very, very reliant on just one lever, and that is quite blunt. It is QE. So we would also argue that in some ways QE has sped up the rate of disruption. So if you look at the big internet and software companies, they now represent 10% of the global market capitalization, which is interestingly, that's where it peaked in the year 2000. So these giants are now, the success of these giants is really starting to impact anyone caught in the middle from a competitive perspective, and governments are starting to push back on them from a regulatory perspective. So keep an eye on that, because those giant software internet platforms haven't needed credit markets. They've grown out of cash flow, but the companies that are increasingly competing against them have done the opposite. They've bought back stock, geared up their balance sheets, and now they're caught in a real fight against some of these big, the Amazons and the, let's call it the FANGs, and in China, the BATs, Baidu, Alibaba, Tencent. So turning to slide 7, how are investors responding to all of that uncertainty? There has been a tendency just to hide in quality stocks as measured by longer-term profitability measures at any price, and also in the growth expressions of those quality stocks. You can see quality now is a 3 standard deviation in terms of how overvalued it is. So yes, we all like to own those stocks, but I think the challenge for a value approach is actually finding the cheap versions of the quality and growth stocks. So we would argue you need to be looking in less obvious parts of the market. At a sector level, turning to slide 8, you can see most of that expression of the more overvalued parts of the market do tend to be the global defensives, so software and internet, healthcare, consumer staples. And then at the right side of that chart, areas that have derated versus their historical valuations tend to be the domestically oriented parts of the market that no one wants to touch because of this political uncertainty. It's driving regulatory uncertainty, and so banking, domestic cyclicals, communications tend to be the cheaper parts of the market. Now, how are we sort of approaching that opportunity set? Well, on slide 9, we're essentially trying to find value and that is, buying growth and quality at the right price. In the global cyclicals, where we certainly had some pain last year, we are starting to see a bit of a turn there. As there's an uptick in Chinese activity, policy stimulus, both fiscal and monetary in China, is feeding through to a pickup in housing prices. We think that will, feed back into a pickup in housing activity. And then ultimately also a turn in the auto cycle in China, which has been very weak. And against that, that you could describe them as the big ticket items. The general consumer environment around services and retail has been surprisingly resilient against the slowdown in durables. So stimulus, I think, can see Chinese growth accelerate in the second half, and that will feed back, we think, into a better outcome for global cyclicals. Now, within that cluster, we'll speak to the specific reasons as to why we own companies like GE and Siemens in a minute. Going through consumer incumbents and domestic cyclicals, we see domestic cyclicals, our biggest expressions there are financials in Europe, China, and Korea. Once again, they will be beneficiaries of an improving Chinese outlook. Europe is the one large economy that is lagging, and we think that's primarily because Europe hasn't chosen, due to a lack of coordination between the member states. There's no concerted fiscal stimulus happening in Europe, and policy tends to be a little bit on hold because of Brexit issues. But I think inevitably national politicians within Europe will respond to the needs of their electorate if they want to get re-elected. And I suspect some of Trump's fiscal, let's call it unconventional fiscal policy of stimulating the US economy at 3.5% budget deficit at a time of full employment may start to get some support for similar policies in Europe. And to the extent that happens, and at the same time exports pick up due to an acceleration in Chinese growth, the domestic cyclicals in Europe should play catch up. They certainly are priced for for no acceleration. So they're at about a 30% discount to similar businesses in the US. In terms of our thinking about the portfolio positioning, and in a world where the yield curve may stay flat for some time, obviously having some growth in the portfolio, some structural growth, obviously is going to work, or should work, assuming the idiosyncratic reasons are sound, and also and you're buying it at the right price. And in December, when Facebook was being hit hard by regulatory concerns, we started building a position, and that stock is now at the top of our long portfolio, where we see an opportunity for Facebook to really, through Instagram, take advantage of a broadening of its advertising business, and at a time when, it really, out of all the large internet stocks, it's the one that's probably taking the privacy concerns most seriously. And that is impacting their margins. So they're investing heavily to improve their outcomes in regards to inappropriate content and removing it as quickly as possible. So that's impacting their near-term earnings. And at a time when we think the top line will accelerate due to the popularity of Instagram, and then more broadly speaking, a shift in e-commerce towards social e-commerce. So we think Facebook has a great opportunity in the core app as well as in Instagram to, through the key opinion leader phenomenon, to basically complement advertising with a take rate on actual e-commerce. So a lot more e-commerce happening in the platform as opposed to users clicking away from the platform. I think that's a major trend, and it's one of the things we've picked up from our research on the Chinese internet players, where arguably innovation is leading the West. It's a big shift that's happening in China, and we think you're really at the beginning of that trend. And it's a trend that favors Facebook over Google and over Amazon. So at 20 times with 20% top line growth, we actually think Facebook is a value stock. So look, moving into some specific examples, on slide 10, you can just see a graphic that is capturing the valuation of our financials, which we are characterised in the cases of ING, UniCredit, Capital One, KB, China Construction Bank, ICICI. We've got a mix of developed and emerging world financials, but they all have significant retail franchises, and we think that is the part of banking that will be, most, let's call it, immune to disruption. And we're buying those businesses at ROEs which imply they should be trading, on average, 30% higher than their current share prices. And we've stressed that all through last year, when our European financials underperformed, their earnings estimates actually rose. Secondly, another great cluster in the growth basket, the software incumbents, where we see a long-short opportunity. We still favour the larger companies, Microsoft, Cisco, SAP, over the more narrow feature set companies, which in some cases we think are interesting shorts. And then finally on slide 12, the global cyclical cluster in a little bit more detail, breaking it out between what we call the conglomerates simplifying, GE and Siemens. And what we're trying to capture on the chart is the parts of GE and Siemens that we think are interesting, if you look at the valuations of those divisions as pure play representations in the market, be it medical devices, automation, aerospace and defence, they're all roughly above 2 standard deviations expensive. And yet you can buy those exposures in GE and Siemens almost, definitely, since 1995 at the cheapest valuation that these companies have traded at. So we think that's interesting. And secondly, you can see we also have exposure to memory by Samsung, Hynix, and then autos is a cluster that we've been building out, looking for OEMs and component companies that are really well positioned for the electrification trends. So turning to slide 13, in summary, the way we build the portfolio is very much starting at the stock level, looking for companies that are offering us both growth and quality, but at the right price. Then via awareness around quant and macro sensitivity, building those stocks into clusters effectively, or building around clusters, and the research process is organised around finding clusters of interest to keep it as productive and as deep as possible. And then looking at ways we can hedge any style or macro correlation that we see building up in a cheap way. So trying to do that, not through the shorts are there basically for idiosyncratic reasons, but looking for additional ways we can hedge out tail risk in the portfolio. So I'll hand back to Andrew to take us through the NTA and the share price performance.
Thanks, Jacob. So turning to slide 14, so Jacob's just walked through underlying portfolio performance and outlook. Let's now look at NTA and share price. And you can see on that chart, roughly 3 periods since inception of APL. Firstly, till early 2018, the share price traded roughly in line with NTA. Then as we approached the option expiry date in October 2018, the share price clearly anticipated dilution from the exercise of options, and that discount closed. And then more recently, perhaps reflecting performance, the discount has grown again, despite the NTA being slightly up. If we put that in context, slide 15, where the discount sits for APL relative to peer global equity managers, you can see as of yesterday, or a couple of days ago, roughly on average with peers in the global equity sector. I can assure you that the company takes the discount to NTA seriously. So what are we doing about it? Slide 16. Well, first and foremost, ultimately, I guess it's clear that the share price is really driven by having more buyers of the stock. And to have more buyers really means buyers anticipating the NTA to rise. So we need to firstly drive performance, and I hope you can see from the discussion we just had with Jacob that the team is working very hard to deliver strong returns from the underlying portfolio. Secondly, we are increasing or enhancing our shareholder engagement via a number of measures, events, adding people to a specialist listed products team at Pinnacle, our partner on the distribution side. So you'll see a lot more activity from us in that regard. We've increased the transparency vis-a-vis weekly NTAs, etc., and there are research reports available also from all the main research houses on the offering. And finally, in terms of alignment of interest with shareholders, we do have more than 9,000 shareholders today, so we've got a very diverse, broad shareholder base. We think it does make sense to have a scale vehicle. It helps with liquidity, but also lowering per unit cost. And we have an independent board, of course. But as a measure of the company's commitment to the vehicle and optimism for the vehicle and also the manager's outlook for the vehicle. You'll see the statement we made yesterday by the ASX, some recent buying by Antipodes and associates of Antipodes means that we now own well over 5 million shares in the company. So strongly committed to the success of APL going forward and optimistic in its outlook. With that, I think I'll pass over to take any questions from shareholders on the line.
Okay, we do have the question. Robbie, as a private investor, go ahead please, Robbie.
Yeah, sure, thank you. Under what market conditions do you expect APL to strongly outperform the global equity market?
Thanks, Robbie. I think, Jacob speaking, the question is really, well, from a philosophical perspective and a process perspective, we really, want to deliver an all-weather value outcome, right? So we're not, unfortunately, we haven't done that in the short term, but, in the process of building clusters and trying to eliminate, style and macro concentrations, we should ultimately do that. So now, in terms of how we see the opportunity set today, we certainly see, given the big discount that the more domestic parts of the market have outside of the US, we're generally positioned in some of those stocks in that part of the portfolio. And 25% of the world index is domestic US. We're not talking about global US, which is dominated by the big software companies, the technology space, the healthcare space, and the industrials and commodities, but everything else, everything left. The reality is a lot of what's left is under pressure from some of those bigger companies in the US. And it's also relatively highly leveraged. So if concerns around the durability of the US cycles, domestic cycles start to emerge, certainly we'll pick up performance for not having exposure there. Now, it's not that we're not looking in that part of the market. It's just that it's overvalued. So we're looking in parts of that domestic that are not under threat of disruption. And we're generally constructive on the US housing cycle. So we think because it's been so underdone. And then if you think more stylistically, if we do get somewhat of an acceleration in growth, we think there is some catch-up. The cyclicals are somewhat attractive, and that part of our portfolio should do better.
Great, thank you for that, Jacob.
Thank you. Our next question is from Simon Samuel, Delta Asset Management. Go ahead, please, Simon.
Yeah, look, I just wanted to know, what do you see going forward? We had that major drawdown going into Christmas last year in stock markets. Do you see that sort of thing repeating going forward as valuations in the States get a little rich, or do you think all will be well, give or take?
I think, it's a good question, and we still think there are build up, it's a question of where is the excess, and that's really sort of identifies where you should be, what you should be avoiding. And we'd argue the excesses of this cycle have really been in the deterioration in weaker balance sheets, in weaker companies. So weaker companies have generally borrowed money. And that's what happened in December. Credit spreads blew out in response to concerns around the durability of the economic cycle, and companies exposed, via weaker balance sheets were punished. So I think that can happen, again, and it's potentially triggered by the stop-start nature of, global growth. I mean, if you think about China, yes, things look okay. They seem to be accelerating, but Chinese policymakers, they'll have to respond at some point to rising house prices, because they really see that as an issue for social stability. Housing affordability needs to be managed in China. So I think by early 2020, you might have tightening. You start to see a tightening of policy again, and that's what I think people should keep that in the back of your mind, and you look for the cheap hedges now, so participate in the upcycle. Don't be too defensive. If you've got cheap companies that are high quality and exposed to longer-term growth trends, I think own them, but be thinking about the tail risk hedges now.
And secondly, shorting in general, because interest rates are so low, people are willing to hold lesser performing companies for longer because the alternative of sticking the cash back in the bank is going to generate zero. Do you think shorting in general doesn't work as well in this environment, especially if interest rates are going to be cut even further?
Our recent performance would suggest that there is a challenge in this environment to shorting, and because of that, just the commitment of the central banks to keep monetary policy so easy. I think if you take that to the logical conclusion, the economy will be full of zombie-like companies at some point that have just been kept alive by the behaviour of central banks and investors. The weaker companies end up being recycled by private equity, so I think that's a pretty miserable world. If you think about that, that means returns on capital will inevitably continue to fall across the opportunity set. And then there's, I think, clearly a tipping point, because central banks don't control money supply. They can print money, but they can't make people spend it. So if we see the credit multiplier falling, I mean, that would be the warning sign that, you need to be, liquidity is actually starting to come out. Confidence is not there. And that's what we monitor very carefully. And that's what happened last year. The credit multipliers definitely fell, especially in China.
Okay, thank you. Our next question is from Jack Gilbert at Indorf Wealth Management. Go ahead, please, Jack.
Hi, Jacob and Andrew. Just a quick question here. So our reporting has shown that over the month of March, the LIC for APL has dropped around 8%. I was wondering if you guys had any main reasons for that, and anything you guys plan to do to get that one back on track. Apologies if this is covered in the first couple of minutes, as I wasn't there. Thank you.
Yeah, I think you probably missed the start of the discussion where we talked about the difference in how you understand LIC returns. I think you're referring to share price, not NTA. The NTA has broadly stayed flat over that period, or even mildly up. Share price, that was the discount issue that we've been addressing, and I think that's sort of extrapolating some of the relative performance that we've had more recently. What we tried to do today is explain how the portfolio is positioned, some of the reasons for that portfolio underperformance, partly driven by the shorts in the portfolio, as Jacob's just described, which has acted as a headwind in a very strong rebound coming into the first part of this year. You would have seen that discount closing a little bit in recent days, and that's perhaps reflective of some of the buying that Antipodes, the manager, has made as a sign of commitment to the vehicle.
Perfect. Thank you.
I think just maybe one more question, given we've gone over the 30 minutes.
Okay, our next question is from Wei Hing, a private investor. Go ahead, please.
Hi, Andrew. Hi, Jacob. Just one or two questions, if you don't mind, and they're kind of similarly or interconnected. One is just if you could provide a bit more colour on the Chinese internet stocks, and I guess it could be argued that they've got more of a stranglehold on the Chinese market than, say, the US. internet plays, or arguably the same? And then two, how you see convergence in the world within industries relative to kind of your conglomerate simplifying theme there, where you've kind of got companies which are expanding into adjacent industries, yet you're playing in GE and Siemens who seem to be simplifying, going the opposite way.
Yeah, that's great. Two great questions. The Chinese internet space is probably had more venture capital money, or as much venture capital money go into it as has happened recently in Silicon Valley. But Silicon Valley sort of targets more of the software, the SaaS markets, whereas the money in China is really going into startup internet plays, and companies like PDD, which 4 years ago really didn't even exist. And what is PDD? It's basically a manufacturer to consumer platform, so a group buying platform for basic consumer, almost like commodity type products. But that is impacting what Alibaba does in its Taobao business, in its marketplace business. Similarly, Tencent, if you look at what Tencent's doing, it's really it's built this mini app ecosystem. So it's trying to keep its users within WeChat and organizing the internet inside this super app called WeChat. So to really cut down their reliance or need to go out to Baidu's search engine. So it's organizing. The search engine's only becoming relevant for the very last tail of the internet, which is actually not worth a lot. And that's the issue why we've cut our exposure in Baidu. Is it's having to spend a lot more to keep users engaged on the platform, and that's not what we expected. We thought, similar to Google, that the search app would simply be habitually a part of everyday life. But this mini app revolution in China is really disrupting that behavior. So it's a great example of where too much capital, chasing too few ideas and leading to a far more competitive environment. Now, you haven't really seen that in the Western internet, but arguably I think it will happen in the software place, part of the Western sort of capital markets. Now, to your second question and around convergence. Look, I think you're spot on, and how important it is now to think about, especially in industrial companies. How are you positioned for a world of, for instance, machine-to-machine communications, the Internet of Things, big data, and it's exactly what Siemens is focused on in there. We see the Siemens automation business as being a unique collection of software and hardware assets. And they have been very forward-thinking in the way that they put their portfolio together to capitalize on the broad trends in automation. And that's why we're there. It's because it's a structural growth story that has been priced as a boring cyclical company. So they in simplifying the conglomerate structure, they haven't given up any of those advantages. And similarly in GE, we see in aerospace as the maker of engines, and in healthcare in the maker of diagnostic equipment. You have businesses that have a high degree of service-related revenues, so they're very annuity-like, and ultimately very difficult to disrupt, and already really do operate on almost like a big data Internet of Things platform because of the in-service monitoring that needs to take place. With all that data going back to GE, and where you're triggering, being preemptive on maintenance, as you see sort of signs appearing in the data. So we think that they're very strong businesses that are mispriced for the growth that's on offer.
Thanks, Jacob. Just like to thank everybody for joining us on the call today. We really appreciate your engagement, and please feel free to contact us if you like any further information, and you'll find a lot at antipodespartners.com and the APL section, information about the company and the underlying portfolio as well. Thanks again. We look forward to continued engagement with you over time. Bye-bye.